Hi everyone, hope you're all doing well and doing fine. Welcome to this week's Bar by Bar trade. That's better. I trust you're all doing well and you had a fantastic week. Let's have a look at what we got for today. See, I've got three charts on for this day. I'm going to start with gold. Gold, XAU, USD, gold to the dollar. So, usual thing that we do each and every day that we trade, which I'm kind of repeating over and over and over again until it becomes almost second nature to how you approach the charts, is your daily setup. And your daily setup is simply this red line here, which would mark for you the low of yesterday. And you can pick that off the daily time frame to be exact and precise. And you also have the high of yesterday, that's that green line, and then you have the open of the day that you have here. Then, of course, there's vertical lines. The magenta lines just indicate for me the open of the session, because I always want to see what's happening right at the open, because trading the open is slightly different to trade the middle of the day or the end of the day. So at some point in time, we'll talk about strategies for trading the open. What's interesting, just with this bird's eye view of the 5-minute time frame, is what you can quickly identify. You can see the low that we've had since the open of the day, and you can see a trading range that formed at the top of the open, and the market is trying to break beneath that. So just make sure that everything's live. Okay, good day to you guys. How you doing? So here's what's pretty important for us to have a look at now. So if we open it up, we'll look at the other pairs just now. So that's what we've got. The session opened here, so that's 5 minutes before the session. That's the first candle of the session, and you can quickly notice and observe that it is a dodgy candle, which is fine. Just keep it at the back of your mind so that you can come back to it as and when it gives you a reference point. At this stage, before this happened, here's what I had on the market. What I was looking for in this particular time frame. So we had a double bottom with a low, or first low of the Asian session. There's another low there, so the double bottom at that point. So at that point in time, when I come into this particular session, the European, the London session, I'm saying to myself, well, if that double bottom holds, and that's a pattern that I look for, that double bottom holds, then I need to see an attempt for it to be tested and a higher low wherever it forms. But you can clearly see here we didn't get the higher low or the entry point for us. So the bears broke strongly beneath that. But is it a strong enough bear breakout, or a breakout could be one candle? But I have to ask myself, what's happening here? The bears are strong. They managed to put 4 or 5 strong candles. Why didn't we close near the low of the candle? And why are the bulls coming back strongly into the market? So my thinking at this present moment in time is to wait. I still have a bias to see. Maybe I don't get a perfect entry here, higher low, or double bottom for me to execute the trade. But I might still get it. Where would I get it? If the bulls are strong enough to put successive candles, okay, and get to the moving average, and be able to get a close above moving average, fantastic. Then basically they would have raised all of this strength. That's almost 50% pullback. Then what I'll then wait for is still wait for my higher low. Okay, so the higher low that I was looking for here, if the bulls are able to reverse this, I want to see an attempt, see what happens at the moving average, and see an attempt by the bear, still resume the trend and then a higher low. So that's the first thinking. But remember, the pattern was double bottom. I'm looking for higher lows. Now I want to see if the bulls are able to create that. If the bears are strong, then I'm going to have to wait to see a lot more bearish price action. I need to see this level tested now by the bears, which will create one test, first test. I need to see a second test to give me a double top, and I need to see a lower high. So a bit of waiting. The bear case is strong. The bull case is stronger, then we might get an entry much earlier. So let's keep our eyes on that and see what we get. Okay, so you guys got the daily setup. We are way below the close of yesterday, but we created double bottom. The bears were strong in the morning. Should have accelerated all the way down, but they haven't. Let's see if the bulls can reverse this. One thing I'm keeping on reminding myself is to really talk about what I look at instead of just. I've just said that I want to see what happens when we get to the moving average. Well, what I'm really looking for in my head is 50% retracement of this bear move. If the bulls are able to get to the moving average, they have retraced more than 50% of the bear move. A 50% pullback is very significant in terms of invisible levels of support or resistance. If the bulls get to the 50% level, plus or minus there, and they fail to break above that, and the market turns, then I'm starting to look for those double tops and the lower highs that I was talking about. So that's kind of, when I say to the moving average, it's a good measure to for me to bear in mind. But technically, we look for the 50% pullback. I'm going to take that off here. What I had here with this measured move, so we had a double top and we had a trading range forming here. So I said to myself, well, if this double bottom here is going to hold, there is a potential measured move. The market breaks beneath this trading range, likely to get to a measured move here. So I was looking for a reversal somewhere within here, and the higher low, but we didn't get that. So let's wait and see what follows. Yen, let's have a quick look at the yen again. As for you guys, for the sake of just working our way through this thing. If we look at the setup, just at a double bottom there, that should be there. Okay, high of yesterday, low of yesterday, and there is open. And again, we are watching above that. So just to open up a bit. So today we're going to be looking at trading pullbacks, for profitability, pullbacks to the moving average. So we'll get to that and we'll just work through our charts, and I will talk you through trades that you take off the moving average, which are really higher probability if you're in a trend that has resumed, lower risk, higher probability, higher profits, but we'll get to that just now. So this is what happened before the open of this closing session. The market created this high, then we had a double bottom here, and the bulls resumed. The bulls that had put up that high resumed the trade. So if you've been looking at this, or if you come into the market, or if you're in it and you're taking any trade anywhere, how far is the market likely to go? Or just quickly step on your measured move, and you can see the market turned within the measured move area. It does not mean that the bull trend is over. It's just an area for you to not take some profits out of the market, if you want to take profits out, and do not initiate new trades at the moving the measured move until you've had a pullback, which you can trade, or if you have a breakout above the measured move, wait still for that test and the pullback. So measured move is good for taking profits, or just observing, okay, I'm just coming to the market, that's not a surprise why it turned there, because as the market broke above that, chances are it might want to reach to that level. So what we then have is at this stage, we had the pullback from the measured move to the moving average. We are still in the trend. Always question what happens at the moving average. That's always something you want to be asking yourself. What is going to happen at the moving average? So bears created close beneath it, but first time in over 20 candles, we have one full candle with a gap between its high and the moving average. We call that the moving average gap bar, which is good because if we have a trend resumption, we want to see if the bulls are able to carry on the trade. They failed to do that, and immediately we created a lower high. So with a lower high from this high at the measured move, with the lower high here, but you still see we have that level, which was a level of resistance that the market broke through, breakout, follow through, and that's now become a level of support. So if you're going to take that trade there, you've got to ask yourself, what happens at the level of support? Am I prepared to take that particular risk and see if the trade is successful or not? Because it's a level of support, my advice is wait to see if the bears are able to break beneath it or if there's an attempt to resume the trade. So if you take a trade here, okay, on the lower high, where's your stop? Well, your stop goes up here. Okay, you only put your stop above here. If you've had a strong breakout and market pulls back, then you can put your stop above there. Anywhere else, putting your stop here while you're taking the trade here. Tight entry, tight stop. If it goes your way, you do make good profits, but that's not the technical level. For the technical level, it's going to be up there. Then when we've broken beneath this level and close beneath this level and get a pullback, then you can put your stop there. In which case, in any case, you didn't get that. Bulls came into the market, bears failed, and we had a reversal candle here. Would you have taken that trade? If you want to take that trade, the stop is going to be up here. That would have been a trade you wanted to take. Lower probability because you're right at the next level of support. But it's a bounce off the moving average. You want to take that trade, you can, but your stop has to go there. And you'd have been able to get out of the trade at the test of this level. Or if you wanted to hold on to it, your stop is still at that particular level. Okay, you wait, there is a breakout with a pullback. If the market starts to turn beneath here, then you could touch in the stop to here. Same thing if for any reason you want to take a trade up here, you want to see the resumption, the market starting to move strongly beneath here, then that becomes a key level that the market should not get back to. At this stage, the market goes above this, it shouldn't be a surprise. But okay, so let's wait and see what we get here. We are in the middle of this high and that low, so right in the middle of it. Best for us to wait. Let's see what happens when we get down here and see if we double bottom, a higher low. If we get another double bottom here, and then we can start to look at going long. Okay, so it's just a matter of being patient because all of that could be profit potential for you if you wait to take the trade in the correct place. You're right in the middle of potential high, potential low, which is the middle of the trading range. You don't want to initiate a trade here, put your stop up here or put your stop down here. Wait for the market to get close to here and see if it bounces off here, create double bottom, lower high, or double top, lower high, or double bottom, higher low, and then take a trade. It's really not necessary to take trade in the middle of a trading range. Okay, euro. Okay, again, you can see low of yesterday, high of yesterday, open of the day. If you're in the market yesterday, I'm not sure you've taken trades. Yesterday was a public holiday in South Africa, so we're not in the market. But some of us could have been in the market. and taking trades. There's a high, there's a low. Then you have a look at coming into the particular this session that we're talking about. Okay, so coming into this session, just here, 5 minutes to go. First trade, bull candle, follow through, but we created a double top. And we created double top at that particular stage. We got a way to see the bears resume. What happens with the moving average? Good question to always ask yourself. The market bounces off. Moving average has made a good level, dynamic level, because it's not static level of support. So the bears will manage to have that double top created. We're not strong enough to give us one close beneath the moving average. Then we get a lower high, but look at that, we're just going sideways. There is no successive bear candles. So what do? You gotta say to yourself, if you are patient enough to wait for the market to give you more information, which means avoid jumping in. See, this law that I'm middle of a potential trading range, the market will come in and say, oh, I'm in a trading range, or it comes and say, oops, I'm now in a trading range. So avoid doing anything here, because chances are, you could just wait forever if you put your stop in the right place, or make the wrong decisions that affect your mind. You're waiting forever and ever, and when the trade comes, because you've already executed the trade, should I get out of this? Should I stay in? Wait for the market to get to these extremes and give us information. If the bears turn out to be strong and they give us candle closing beneath here, give us a follow-through candle. Okay, if bears are strong, but we track into the low of a potential forming trading range. So let's wait and see what happens when we get here. Will we smash through, pull back, or are we going to get another double bottom high low? So it seems a lot of waiting, but we're not waiting aimlessly. We're waiting for information to come our way from the marketplace. That's what we aim for. Okay, so my apologies. I should have put my phone on silent. Okay, so just the three currency pairs two currency pairs and the commodity we're looking at, that's what's unfolding before us. We said for gold, let's see if the bulls will get to the moving average with strength. And if they do get the moving average with strength, if they close above it, fantastic. If not, then we look for higher lows. So that's what we are waiting for. Now, what I want to do is I'll just open up any of the charts and let's start looking for these pullback to the moving average, because if you can trade those well and if you can train yourself to be patient for these setups, this can actually turn out to be a pretty profitable strategy for you. So I'm just gonna scroll through and talk you through some things. Well, let's look at what happened with the Asian session right here. Okay, on the euro versus the dollar. So you had this sideways price action, and anytime you have sideways price action, you do know it's a trading range, and the market may make a major move of it. So the nearest move that the market could go to is that particular move. So you'd have seen that, and the market went up to there, and you're waiting to trade pullbacks to the moving average. Let me just have a look at the question that's popped up. How do you create your three-level fib? Let me show you quickly. Okay, I'm just gonna click on it. Okay, so it's a Fibonacci tool right here. Then once you drag it onto your chart, double click on it, go to Fibo properties. Okay, and on Fibo levels, all you need to have is 0, 50, and 100. Okay, So on FIBO levels, delete everything else, leave the 0 level, 50 level, 50%, 100% level. That's all that you need. Then you can play around with the color that works for your eyes. Still under FIBO levels, if you go to common, you put dotted lines, etc. So that works for you. So that's how you do it. Okay, excellent. So that's where the market is likely to go to. Now, would you have taken that particular bounce off the moving average? No, the reason not, based on what we've discussed before. We always want to see a breakout for us to be able that there's a breakout and follow through. So that's a breakout candle, okay, because it's broken beneath the moving average, that low, etc. So I would have wanted to see a follow through candle. Okay, that's a candle of any size, but provided it's followed through. In other words, broken beneath this low, and it's a back candle. Then I can look at a pullback. So I didn't get that. I wouldn't have taken that and leave that. So now you just kind of wait. You have a breakthrough there. You have a follow through, but you're right at the measured move. So wait to see what happens. The market gets there and it pulls back. That's what's going to happen. The moving average, bulls are strong enough, get over the moving average, follow through, but immediately there is a failure and we have a lower high double top at this stage. So you're not in trades yet. Okay, and if your strategy is just waiting for pullback, so that lower high for you is a signal to say, well, there's potential continuation of this move by the bulls. So I've got the double top. Remember, I always said even earlier, let's see the pattern. The pattern is a double top. Then let's wait for confirmation. There is the bear signal candle. There is the entry, and then there is a pullback. Okay, so there you can start to think of wanting to take the trade. But you have a look at it and it's right at the moving average and say, I want to actually trade something that's coming off the moving average. So bears resume, they fail, there is a reversal there. So it's all coming off the moving average. They break beneath it, went up to moving average and below. So coming off the moving average after the lower high, you could take that trade. Okay, that is a pullback. I wouldn't take that because it's right on moving average, but you can take that particular trade if you want. If you didn't take any of those trades, sorry, by the way, when you take any trade here, your stop is going to be there. Okay, that's where your stop is going to be at this stage. Anyway, in here, you're taking your stop there. Then bears continue. There is that double top, that potential double bottom level there. Okay, so anything you see in here, you're concerned about what might happen here. Still bearish strength. We have a pullback and we have a decent 2-bar reversal. Okay, that's a very good trade to take. 2-bar reversal off the moving average. You can take that, or you can say, okay, I know I've pulled back, but I'm right at that level of support that I saw. I'm not comfortable taking that trade. If you take that trade, your stop now is going to come up here. Okay, if you don't take it, that's fine. Just wait. Market breaks beneath that, pulls back. We have a test of the moving average here. If you take that trade, your stop is still going to be up here. Okay, that's very important where to put the stop. We've got to wait for the market to break beneath the level, pull back for us to start to tighten our stops. In any case, reversal back into that level that we had. But again, we have another 2-bar reversal, lower high. It's a good signal for us to take because now we have the lower high here. We have potential entries that we may have taken here. We have another lower high here. We could take that lower high, but that lower high, if you take that as a trade, you're not taking a test of the EMA. Okay, you're just taking another lower high. You could take that because of the strength of that. Stop still up here. Okay, the stop is still up here. Potentially, how far could it go? Okay, so that's the area where you're going to be thinking of taking profits. Okay, so this trade here is not a pullback to the moving average. That's a lower high trade that you would take. Okay, I wouldn't take that because of the, it's a bull candle. You have to be very quick if you're going to take that in case you get a reversal. Okay, so let's just go through a bit more. I really just want to show you these particular trades that you should be concentrating on if you're taking pullbacks to the moving average. So down here, okay, you'd have observed all of that. There'll be measured move. The market is likely to get here. Let's put it in George. Okay, sideways, potential measured move. Market gets to don't worry about that red line because remember we marked it for today. So there would have been other levels you'd have marked in there. But measured move, market turns, we have a double bottom. If you get a double bottom, you gotta wait now for a higher low. Get a double bottom, wait for a higher low. There you get your higher low, which is closing above the moving average. You can take this. It's not a pullback to the moving average, but it's a higher low. Take it there, stop there. But remember, we're waiting for a test of the moving average, so we wait. Market. So now, based on that, there's a higher low. So now we are in the bull leg that we're looking at. Market does pull back. There's a micro double bottom here. Micro double bottom. Let's just make sure I don't. Okay, that's a double bottom that's just separated by two candles. So when we talk about bar by bar trading, when we say every bar is important. So there we are. Bulls are controlling the market. Okay. If you haven't taken this, remember to take a pullback to the moving average, you don't have to take earlier trades. You have to see with someone who's taking these higher lows has executed the trade to say to you, okay, we are in the bull leg, to the bull leg in a trading range. It could be just a strong bull trend. We are in there. I'm waiting for a pullback to the moving average. So someone has taken the entry there. They would have put their stop here. Now I'm seeing the bulls are still in control. Micro double bottom. This is a breakout mode, inside outside pattern. Market tries to break beneath, fails, creates a double bottom. There's a double bottom before we get to this one. There's a double bottom. Okay, that's the moving average would have been rising at that stage. So you want to wait, okay, for a decent candle. If you want to take that with a double bottom, but it's still a doji, you can expect that the market could go sideways or come back against you. In which case, if you do that, always put your stop in the correct place. So we've taken the trade there, and we're taking right there. So if I'm taking it there, I'm going to put my stop there. Okay, that's a safe place to put. I can be a little bit more conservative here, but that's fine to put the stop there. Then we get this candle that is an entry for that candle above that doji, above that double bottom, also creates a micro double bottom. Micro double bottom is double bottom made by two candles. So it's confirmation, bullish strength, and I get that. That's a trade you can take. It's coming off the moving average. Your stop has to be here. Okay, you can take that trade off the moving average, and your stop is there. If by any chance you've taken that trade and your stop was here, okay, then you can move your stop from up here to here. That's what you do. So there's a trade that you average, and then we're gonna wait and see, are we gonna get any other test of the moving average? I'll come to the question right now, just now. So we're continuing where so we took a trade. There's a follow through candle, so entry candle decent. Market tried to reverse there, failed, follow through. So strong bullish price action. Then we have that bear candle, which most likely profit taking. Why would I say that? Because if you're looking at measured moves, sideways price action. So if you're taking a trade, how far is it likely to go? It might get to there. Then you get that fantastic. You can take some profits off. You can take all the profits off if you want. As it begins to turn, if you hadn't put your profit at the measured move, you take profits. You can then take your profit as it begins to turn. That's perfectly fine. But look at what happens at the moving average. Okay, decent 2-bar reversal. So there's an entry above that, that you can take, and you got to find where to put your stop. So your stop now, because we've broken above these highs, could be here where those double bottoms. That's a safe place to put it, or you could put it there and take a trade. And based on what other levels you've seen, you can hold on to it, or if it starts to go sideways, you can close it. You could take that trade, you can take that trade off the moving average. So focus on the trades off the moving average. Here, that's a 10 moving average, which indicates for us I use that to look for trades in a strong move, strong breakout as it comes off the moving average. And I particularly want to take the first test of the 10 moving average. That I'm always interested in. Just different questions. As your solid blue line, your moving average, what is the dotted line next to the moving average? Hi, Ramona. So the solid blue line is a 20 EMA, that's 20 moving average. The dotted blue line is a 10 EMA. Okay, so that's a 10 moving average. And that one is a 20 moving average. So I use the 10 just as a visual reminder, if you want, instead of drawing trend lines. That for me is an indicator of strength. So as long as the market is holding above that, I want to take bounces off that. The 20 EMA is the one that is also pretty common for trends, and that for me is a good indicator of continued strength. So if the market, I think we're looking at the euro, same euro we're looking at, and they said we had a double top. Could have been the yen, but anyway, double top, and let's wait and see. And then at the moving average with the 2-bar reversal, at the 20 moving average. So there's a potential end to a trend. What's happening at the 20 moving average? That's something that I'll be keen to look at. Let's have a look at this. So a bounce off the 20 moving average, that's a decent entry. Again, remember, I haven't looked at whatever has taken place there. But you see that you want to take that trade. You put your entry above there. What you're anticipating is the market to move. If the market turns immediately when you're expecting there to be acceleration, I'll get out of the trade. There's no point waiting for the stock to get hit. Okay, it's just a okay, on this particular day, I mean, if you just zoomed your eyes, where would you see the potential trade that if you just waited and waited and waited, where would you have taken a trade in the Asian session on the 27th? Okay, there is a trade you'd have taken. You have a lower high here. Okay, so all of this stuff never measured moves. I could go to a measured move there. Guys took their profits. Whoever took a trade, what happens at the moving average? Bulls follow through, immediate failure. So that's a lower high. And then look at that follow through by the bears. Then you're waiting to say, well, how do I get into this? Let me wait to see if I get something bouncing off the moving average. There is one you would have said, okay, that's a potential bounce of the moving average, for doji. But I'm going to put my entry beneath that. It's fine. The fact that it went above you does not matter. So you could have put your entry beneath that, one pip beneath that. And if you got triggered in, let's assume you got triggered. I don't know if you got triggered, maybe not. But if you got triggered, the stop is in the correct place, right? So just wait for it. Nothing happens. If you got stopped out, you got stopped out. Then you get an even better entry following through. Who's attempted to break this micro double top? Okay, market went up, came down, went up again. Who's attempted, but they failed. Okay, and the market closed beneath that. So that's a trade that you'd have taken. But your stop is up here. Put your stop up here. And where does this one go? Remember, you always want to consider where you want to take your profits, guys. So measured move, let I kind of just sit and try and hold up to there, unless you have a break above the moving average, follow through by the bulls, at the top, the thing is reversed. So if you take that, you're trying to say, I wonder if I'll get to a measured move down here. Okay. Another thing, remember we spoke about leg 1, leg 2 using the Fibonacci expansion tool. Okay, there is the first leg of the move up to there, and then there is the second leg. So the second leg resumed here. Right. So measured move gives you the maximal profit. Leg 1, pullback. Leg 2 starts to give you the earlier profit. So you always have a choice. Right. If you want to take your profit, you want to take all of your profit. I have no problem with that. Take your profit off at the earlier profit there. So you would have. Okay, just less than 1%, but that's fine. It all adds up. So you could have taken your profits there. If you want to say, okay, I'm going to hold on and let's see if I can take maximum profits that I could possibly take out of this, then I'll find that one. Okay, there we started investing there. The market does this test of the moving average. If you put an entry there, there's nothing there, nothing there. You don't enter beneath an opposing candle. In other words, counter trend candle. So don't do that. You wait. If you put your entry there, say, well, let me put an entry there. Your stop is up there. Okay, it would have been triggered, it would have held. If you hadn't taken that, here is another better entry. Why? Because it's a tighter entry, so the risk is less. Okay, so you would have taken that and aim to take your profits at that level, the measured move level. That's where you want to aim to take your profits. Okay, a lot of things are also happening in there. There's that, didn't quite get to the measured move, but we could have taken. So there is a trade you could have taken. There is a trade you could have taken. Simply by saying, okay, my particular strategy that I want to refine and work on is pullbacks to the moving average, and that's all that I want to trade. So if you do that, you'll be able to see trades. Let's jump to gold and let's have a look at things of gold. Remember gold again. We were speaking earlier on when we started to say, well, let's see what happens with the bull. So this is not giving us a lot more information. I would have wanted to see a couple of other candles or one more at the bulls to get to there. Then I would have comfortably look for a higher low. As it is now, we are going sideways and we are beneath the 50% pullback. So I want to see what happens. The bears might come back into the market with strength. So we wait. Okay, so $28 is this month. Interesting. Excuse me, Karen, just going to mute my mic. All right, sorry guys. My apologies. Okay, let's just recap quickly on that. So with gold today, where would you have taken a trade if you're looking at this chart? So if you come back end of the day, which I think most of you do or you should be doing, and saying where would I have taken a trade? If I had been patient, where would I have taken a trade? Well, there's one easy one there, okay? And when I say one easy one, it's because, we see You see that breakout beneath here? Bear candle, inside candle, that's a breakout mode. So whenever you see one candle inside the prior candle, that's a breakout mode, usually in the direction of the candle that you've seen. So if you were in the correct setup, in a bullish setup and with a bull candle, I'm expecting there to be a bull breakout. Here I'm expecting a bear breakout because it's an inside pattern, absolutely classic. So I get the follow through, the breaking out beneath that, slight breakout beneath that. That's good. Do I get another candle? I get another candle. So I have my bear breakout. Okay. But because I'm not trading breakout, I'm trading a pullback to the moving average. I just have to wait and see what the market gives me. So there's a pullback. You're waiting to see what happens. Don't get confused and start to think about going long. We are waiting for that breakout. Now, what I marked here, okay, there's a series of measured moves. I'll come back to this just now. Okay, bit of a sideways price action, then measured move if market breaks beneath that, and it gets exactly to the low of yesterday. Then to break out, pull back, then the bears resume again. Market goes sideways, and we get our breakout more pattern. So that's fantastic. So we're saying, well, okay, so we go to that, but what happens, between the open and the low of yesterday, the market breaks beneath that, how far is it likely to go? You could measure that. Or you could simply say, well, let me look at that bear breakout. If the market resumes, how far is it likely to go? Okay. So remember, measured moves give you confidence to take a trade, and they give you an idea where you want to take your profit. Those are the things that you're going to bear at the back of your mind. So here we have a breakout, we have a pullback. We're not surprised by why is the market turned here. It's a measured move. We expect that in the measured move, the market will turn, there'll be profit taking, there'll be boost. Bulls also see that, say, let's try and initiate a bull reversal. So all sorts of things happen here. But we've seen the breakout, right? And waiting for the measured move. There is the strength of the breakout. Let's see what happens at the 10 moving average. We get that. When you get that, you're going to be so quick to jump in. And the way that I do it, I set it up on my terminal, and I'm waiting to see if the market is going to close. At some point, you probably have 30 seconds. The market hits its low or near its low. You can set up one pip beneath that. And as long as it closes as a bull can, as it's close to closing as a bear candle, just put the order in the market. These things happen too quickly. You may not be able to trade by selling the market. So sometimes I do that, but I hate to do that because you try to think and process. By the time you say sell at the market is down here, it's reversed, you're confused, you're not sure what needs to be done. So there is a decent entry. Where would you put your stop here? Now, I would put my stop somewhere just above here. Okay, there is my breakout pattern. So there is the ideal place to put it, but because I've got bull candles, and I just want to put it above where the bear started. So I would have put my stop above there. Nothing wrong with here, you can do that, but I prefer just a little bit more being conservative where I can. So that would have been a very decent entry to take. And where we go, how far do we think we can go with that? Now, there is the breakout. And again, if you want to see where to take your profits, there's my breakout. So all of that you'd have seen because you've seen that happen, right? You have seen, okay, there is a potential how far this thing could go. Okay, so let me see where I can take my profit. Later on, you can put leg 1, leg 2, it will be somewhere within there. Let's put it in there. Okay, so here's the first leg. Today, right, so there's the second leg resume. So your profit from there to there is about here. So you can take it there, or you can just wait and let's see what happens. It starts to turn, you can still close your trades there, because that's the full move. Or you can rely on your stop. Rely on your stop and see what you get. There's still some potential to get to the full profit. Just move this out of the way. Let's get cluttered. Okay. So we have our entry candle is a strong bear breakout. We know profit taking, even if we don't consider that moment, we consider as best strength coming off my 10 moving average. That's why the 10 is also important, guys. Coming off my 10 moving average, there is still room for the market to test the 20 EMA, and I want to see what happens there. So if I get the market turning again with that, it's a decent 2-bar reversal, take the trade at that point. And now you can put your stop up here. Take a trade. If it goes and turns against you, get out, lose some profits, doesn't matter. But now we get that, then we get sideways price action. Okay, we can see that the bulls are strong. But how strong are they? They're always strong to the moving average. I can't emphasize that enough. Always strong to the moving average. That's the first thing they're going to do. We're going to see what happens with the moving average. So if you haven't taken your profits here, I would take on that failed breakout and reversal. I'll close my trades, take my profits, wait to see what I get at the moving average. I have the test at the moving average, 20 EMA. That's a decent trade if you want to take a trade, which is your entry beneath that. You can see immediately you get triggered in and then it turns. When that happens, just close the trade. Okay, close the trade because your stop is either here or here. So you might lose a bit, but you made money. That's perfectly fine because you cannot not take a trade. Remember, random distribution and the probabilities of success. So it could have gone all our way and say, "Oh, fantastic, made money." But if that happens, that's fine. So good trades we have taken 1, 2, 3, even though we were able to close that pretty quickly. Okay, let's just see if we can see anything else. Okay, beautiful, beautiful. So again, just to emphasize that nothing should take you by surprise. Things shouldn't be happening. So you come into the market, whatever time. So this is later part of the Asian session. You see all of that. You can just say, okay, what happens if the market breaks? We're going sideways. What happens if the market breaks beneath that? How far is it likely to go? Okay, the market is likely to go there, and there's a breakout candle, bit of follow through, inside candle, and that's a breakout mode. So if you were trading breakout mode, that's another strategy we'll talk about at some other time. You'd take that particular trade. I mean, that's a classic setup. Bear candle, inside the bear candle, take it, stop up there or stop up the output up there, the tail, and you can see, just take your profits down there. So no big surprise there. Then we get this double bottom. Market turned at the measured move. We have a double bottom, and now you're saying, okay, how do I get in? Let's see what happens at the moving average. Good question. What happens at the moving average at the 20 EMA? So if the bears are strong, don't allow a test of the moving average. That's perfectly fine. They put a 2-bar reversal, and the trend continues. And even if the bulls manage to close above it or create a gap bar, the bears are strong, they're going to reverse it and come back to test here. But we've seen that reversal, micro double bottom, all of those things we talk about, close above the moving average. Close above the moving average is important because it's a breakout. It's a breakout above the moving average for me. There's a little pattern in there, so don't worry about that for now. Follow through. Now I'm waiting for my pullbacks. Okay, I'm now waiting for my pullbacks because of where I am coming from. Let me show you another thing very quickly, just to emphasize the whole point of continually search out for patterns, continually search out for information from the market. So you ought to also have put in that measured move because it is sideways, right? Market went up, came down. So if the bulls are strong enough to break above, forget about that gentle line. I think it's 2 days open. But if they're able to break above this low and that low, that sideways price action, how far are they likely to go and take some profits? Or where am I likely to see a pullback? Because I'm now waiting for a pullback. I don't want to be surprised. So there is a pullback coming, but as the pullback comes, 3, 6, look at that, 8 candles, okay, closing on or near their high, very strong bullish price action, which has reversed more than 50% of this bear candle, not bear candle, bear move, okay, from the top of that to the bottom of that. Okay, so halfway, 50% is the key level in price action. So half of the bear move has been reversed almost by that. So now I'm waiting for my pullback. There is the first test of the EMA, 10 EMA, because of that strength. Put an order above that. I don't think it has been triggered there. But if you had been triggered now, your stop, the correct technical level to put your stop is down here. But when you see a breakout because of the 50% pullback, okay, so that's, I'll just put it the same height. And, you could put your stop just beneath the 50% pullback. Okay, why would you do that? Well, if the bulls are strong, the market can come and test the 50%, but it should not break beneath the 50%. So that will be fine. You might get a bit of downward price action. As long as it doesn't go beneath the 50% pullback, then you are perfectly fine. So you can do that. Another thing that you can do, which reduces your risk further. So if you say, okay, that's the correct stop level, and I've reached 1%, for example. So put your lots, whatever number of lots, at 1% here. Then when you are triggered, tighten your stop to below the 50% level. So basically you're risking 0.5%, right? Because the market should not come down there. So you can do that, if you don't want to sit there and start doubting yourself. The market comes back, has it tested the 50%? So it's likely to carry on, because you might just get confused with all the price action, and then it's already turned bearish, and you haven't seen the double tops and lower highs, you end up losing more than you can. So that you can do. So you're just risking 0.5%. That's perfectly fine. So they're not triggered if you had if you stop. But now let's assume we're waiting still for what's going to happen at the 20 EMA. Bearish price action, very good reversal here. Put your entry above that. Stop again down here or the 50% level. That would have been a decent trade. Had we been triggered, but we're not. Now we take that trade, and that's what we've been triggered. So all you're doing is just waiting for the moving average. Now, let me just show you this quickly. Here's a test of the moving average. Problem is this is only one thing. It's a bear candle. Okay. I do not advise you to take any test of the moving average with a counter trend candle setup. Because you're buying above a bear candle, it is likely to fail. It might fail. This went up a bit further. We say, oh, okay, George, I can manage this and not lose money. But more often than not, when you start to track these things, you will find that if you buy above a bear candle, okay, put your entry above it, it can turn pretty quickly against you, and you don't want to get involved in all of that unnecessary emotional price action. Okay, here's another one which I wouldn't have taken. It looked pretty beautiful when it's done, but had that been a candle that we have wanted, we would have taken that particular trade. Okay, so we would have taken it there. Other thing that I want to just ask guys is I want to have see if there are any questions, if anyone has got any questions. Nothing in the chat box. Okay, so have a look at what we got. Yen. Okay, so the yen is still going sideways for us. So as long as we have price action going sideways, there's nothing for us to do. It can be quite a frustrating journey waiting, because I think the perception that most people have is that from the 5-minute time frame, things are moving so fast you don't have a chance to think. Well, things do move very fast. You don't have the time to think. Only if you are in a trend, right? Then you just wait for my pullback. 4 or 5 candles later, I got my pullback. I need to execute the trade. and just move. But otherwise, there is things are really paused. They paused, not the right word. Things are really steady. They plod along. There is enough time for you to reflect and think and make the right decisions. Now, when you gotta remember again, we spoke about it last week at great length. So if you want to have a look at last week when we were talking about losing trades and how they can help you with your discipline and refining your strategy, you always have to remember probability. The trader's equation, you always have to bear that in mind. Risk, you can measure, you know where to put your stop, always at a technical level. And I must emphasize that you get to understand technical levels as you go along. Put your stop at a technical level. For example, as I said, if you wanted to enter anywhere, if you just said, okay, I'm gonna sell here. For whatever reason, you say, I'm gonna sell here. There is nowhere else to put your stop except here. That's been conservative, but here is a proper place. Okay. Or if you say, well, I'm just gonna buy, you can put it here, or you can put down here. That's where your stop is. So, and you control your risk. You also control your reward. Where are you going to take profits? Am I going to take profits at measured move? Am I going to just hold and see if I get more than the measured move? You make that decision what to do. And then probability. Now, you have no control over probability. The control that you have is in the selection of your strategy. Like today, we're talking about trading pullbacks profitably. Now, you can see, and you can go through any chart that you want. Just bear in mind some of the principles that I showed you. You see that they are profitable, but you have to wait for them. Waiting for them means you have to bite your fingernails, sit on your hands, and do nothing as the market forms and presents the information to you. When it presents to you and you see the pullback, then you have to execute it because you have a higher probability of success. That means when you trade that strategy, you've got to know, I always work on 60% probability of success with pullback strategies. But I know, like I've shown you, if you are patient enough to wait for everything to appear before you, that probability increases 70%, 75%, etc., provided you've managed everything else, the risk and where to take your profits. So that's what you got to bear in mind. And pullbacks to the EMA, both the 10 EMA when you have a strong breakout, and the 20 EMA can be quite profitable strategies if you wait for them. You can then always add other things. So that could be one strategy. You could trade trend reversals, you could trade breakout modes in pattern, trade, many things you can add on. But I think one of the staple ones that you need to work on is trading to the moving average. So guys, unless there are any other questions popping up in the chat box, okay, which I don't see. So let's just wait and try and use the next few days, at least if this is not part of your strategies, to add it in, or if it is one of your strategies, to really just focus on it and see what kind of rewards you get as the week unfolds. Let's have a quick look at the question. Okay, excellent. Thank you, guys. Thank you for joining. I appreciate all the guys that are tuning into the session. And we'll catch up with you next week. Remember, any questions to the organizers, the angel, and the crew, and they'll get back to me and I can prep for next week. All right, guys, take care, and I appreciate your feedback.